Hello everyone, welcome to the Hotel Beau Riviera. My name is Ray, this is David, this is Aiden, and this is Dave. Today we are presenting our performance in 2016. Hope you enjoy. Hotel Beau Riviera is a business and leisure city waterfront hotel, combining 250 guest rooms, 125-seat restaurant, adjoining 50-seat bar lounge. 2,000 square feet of conference and event space have flexible configurations for up to 200 customers. The hotel also has one big exercise room and a small pool and outdoor recreation area. The hotel also provides a free parking ramp, digital national and international telephone service, guest laundry and dry cleaning. Last but not the least, room digital entertainment and room service. Currently, along with the other hotels in the market, the Hotel Beau Riviera has experienced a steady performance decline over the last 2 years. A soft economy, along with the increased competitors from the other cities, have combined to erode occupancy, average daily rate, and gross operating profit. The hotel will position itself a four-star upper-scale business and leisure city hotel, providing high rate and high quality service to the premium and large groups segments. In the first quarter, work will begin to improve the condition of the facilities of the hotel, including the soft refurbishment of the premium rooms and a deep clean of the standard rooms and the common areas. Additional service and facilities will be selected based on the likely appeal to the target segments as well as their ability to generate the revenue for the hotel. We were using the concept rate and historical rate as our benchmark rate. Considering the decision of renovation in the first quarter, we will remain at this price and mark up the premium rate by 18%, and the remaining rates will be modified respectively. In January, we were using rate parity function to test our benchmark rate, and we review pricing for the rest of the quarters based on our first month performance.
Well, hello. We're going to be looking at our annual summary for the Beau Riviera. We're going to start with a financial review. At the end of the year, our market share performance of 19.36% was below what we had hoped to achieve. However, our gross profit margin for the year of 33% indicated a movement in the right direction. When we looked in detail at the net income margin, the picture was not quite as positive, indicating that non-operating expenses were significantly hitting our bottom line. Significant consideration should be given to the impact of property and depreciation, as well as marketing and sales and administration expenses, which may not have delivered ROI in line with our expectations. Marketing review. Penetration within the core segments across the year remains static, despite pursuing a targeted marketing and channel distribution strategy. This indicates that perhaps there was a requirement to increase our marketing spending. It may also be attributed to the limited time available for the advertising strategy to achieve momentum and gain the desired market penetration. Refurbishment facilities and services reviews. Given the soft market conditions, a decision was made not to engage in any major refurbishment projects for the year. Instead, soft goods redos were completed on premium rooms, meeting rooms, the bar and lounge, and common areas within the hotel throughout the year. It was hoped that these would improve the perceived quality of the hotel's offering. However, this did not appear to be the case when looking at the hotel's price-value positioning at the end of the year. In terms of new facilities commission, retail shops and travel and tour desk, valet parking, and lobby kiosk came online over the course of the year. This did not support a significant increase in demand from our target segment, indicating that holding off on investment and considering more appealing options for investment later in the year would have been a better strategy to pursue. Channel review. Having reviewed the channel cost, considering the margin charge and identified target segments, a decision was made to sell primarily through direct channels. While this is the cheapest channel for the hotel to distribute through, it also enables us to control the customer data and build a closer relationship with our prospective guests. Similar to marketing penetration, the channel strategy needs to be deployed in a more aggressive manner in order to demonstrate improvement in the revenue mix over a short course of the year.
So now, after the yearly review, we're going to now start with the quarterly analysis. I'm going to take you through the first quarter, which we start with a small outlook, which we received, and the economic condition will show a significant improvement according to our research. However, it will still be very well below that of the 2 years and 3 years prior to that. There's a moderate upswing expected which will have an effect on business and corporate demand, and this is due partially to the relocation of new corporate headquarters into our area. There is also an increase of RFPs for corporate contracts for long-term occupancies, military, tour, and technical professionals expected. If now we go a bit more into details, we had a higher occupancy on weekdays than on weekends, which was aligned with our strategy as we focused mainly on the business traveler segment. In general, we had slowly but steadily increased our occupancy in the first quarter, however, well below our competition, as we can see if we look at the occupancy index. We began with a higher ADR than our competition, but it fell below our comp set by the end of the first quarter. The reason for this is that we lowered prices in order to gain market share. Unfortunately, our RevPAR decreased steadily along as well. This is also due to the dropping occupancy rates and our drop in ADR. Our net revenue decreased slightly in February before increasing again in March. This was mainly due to the soft goods redo for guest rooms premium as well for the meeting rooms. In addition, we also started cleaning several facilities such as guest room standard, lobby and public area, restaurant and front desk. Due to this, our GOP also dropped during this time, and we only achieved a net profit by the end of March. Our aim was to have everything completed in the low season, but doing this all at once supposedly cost us some potential customers. Our revenue derived mainly from bar standard rates and large groups as intended. However, revenues from the premium and small group segment were not up to expectations. Surprising for us was that we also generated a substantial amount of revenue from the guaranteed and contract segment, which we had not targeted. To summarize the first quarter, I would like to present the following numbers. Our market share was down to 18% from 20%. GOP was at approximately 24%. Weekday occupancy was 52%, weekend 46%. This resulted in a total occupancy of 50%. According to our competition, if we look at the occupancy index, we were 0.89, so well below them. Guest satisfaction was around 75%, but we were still missing facilities requested by the customers. Our market penetration index for transient groups was 102.3, which was slightly above our competition. Market penetration index for group was 71.3, well below our competition, not really satisfactory. Rate efficiency was at 98.98. We had an ADR index of 1.05 and a RevPAR index of 0.94.
To continue the trend of quarter one, the hotel performed in a good direction in quarter two. Bar rate increased from $160 to $170 at the end of the quarter, which is a 6% increase rate in average. Hotel will stick to its strategy and continuously generate about 5% increase in room revenue each month. Net profit was increased by over 110% compared to the first quarter. Due to the completion of the room refurbishment, guest satisfaction remained 65% in average. New Air Career and a discount airline brought in more leisure guests than the first quarter. In addition, a decision was made to pursue a group contract business in May, which guaranteed 2,800 room nights for the month. Hotel expected this contract would boost the occupancy during these slower periods, especially when a competitive bid that will still earn significant revenue can be charged. Premium rate and bar rate had been largely increased due to the secured occupancy. Total occupancy in May achieved 78%, which significantly improved our room market shares. Overall, we achieved a 70% occupancy in average in the quarter two. Large group market index had a significant increase. Net profit and ROE also had a stable increase. However, compared to our concept, the remaining market index still showing we were under the market average. The key possible improvement for this quarter is to maintain the right rate strategy and improve the rate efficiency.
We had a higher occupancy rate on the weekends due to our efforts in channel and advertising strategies to attract leisure guests. We perceived strong competition among our competitor set based on pricing to attract these customers. We fought hard during the quarter to maintain our ADR as we could see fierce competition had begun. In RevPAR, we increased from 108 in the second quarter to 119 in this third quarter. In revenues and profit, during this quarter we saw a steadily monthly increase in our revenue and profit. This allows us to open the lobby bar in August in order to attract more customers, as well as accumulating funds for fourth quarter refurbishing. Revenue mix. Like previous quarters, our revenue derived mainly from bar standard rates and large groups as intended. However, generating revenues from premium and small group segments was not as expected. Our figures by the end of the third quarter are as follows. Our market share remained relatively stable. We had 19.27 for the second quarter, and for the third quarter we're at 19.38. Our GOP was 34.47. In terms of occupancy, our weekday occupancy was 67%, weekend occupancy was 71%, and total occupancy was 68%. Guest satisfaction was around 60%, but redos and new facilities were on the way and demanded by the customer. Market penetration index for transient was 93.25. Market penetration index for the group was 104.3. Our rate efficiency was 98.22. Our ADR index was 1. Our RevPAR index was 0.98.
When we look at the final quarter, we know that air travel was not expected to pick up, and we did expect, as a result, a slowdown in overseas travellers. This would also indicate, however, that there would be an increased demand in the local market and domestically. Occupancies across the market were projected to reach 57.5%, with leisure demand outstripping business demand across the period. We would ascribe this to the forthcoming holiday season, Christmas parties and family get-togethers, and would hope to gain market share within the small group segment. Despite marketing initiatives and new facilities and services becoming fully operational in Q4, we experienced a decline in overall occupancy throughout the quarter, with total occupancy coming to just under 61%. While this exceeded projections across the market as a whole, we under-indexed versus our competitors, with the competitive set achieving an occupancy rate of 63.5%. ADR in this quarter moved considerably. Following the drop in occupancy experienced in October, a decision was made to reduce rates in order to attract additional guests. However, as this did not have the desired effect on demand for our hotel, the decision was marginally reversed in December in order to maximise revenue during the month of December. RevPAR for the quarter underperformed compared to the market, and this can be explained when we look at the decline in RevPAR during November and December. The highest RevPAR for the quarter was achieved in October, and this can be attributed to the higher ADR achieved in that month. Revenue for the quarter was a little over $2.5 million. The impact of this on the bottom line resulted in poor GOP of $790,000, almost half that of the previous quarter, and this resulted in a net income of $155,000. Poor financial performance can be attributed to the decrease in room revenue across the quarter, with other departmental and undistributed expenses remaining fairly static, indicating considerably higher fixed costs that will not vary in line with occupancy, which declined steadily throughout the quarter. Our revenue derived mainly from the bar standard rates and large groups, which was in line with our strategy at the start of the year. However, we failed to capitalise on the opportunity presented in Q4 through this growth in the small group segment. To summarise, by the end of the quarter, our market share was at 19.4%, which represents an improvement since the end of Q1. GOP was at 33.69%, ahead of the 25% target set for the year. Total occupancy was at almost 61%. Guest satisfaction was 100% for services, but had fallen to 52% for rooms and common spaces. For transient guests, our market penetration index was underperforming against the market at 97.29. For groups, it marginally overperformed at 100.13. Our poor rate efficiency of 89.12% indicates that there is significant room for improvement here. Our ADR index and RevPAR index performed largely in line with the market, with RevPAR coming in at 1 and ADR index coming in at 1.02.
Our pricing strategy is based on the market forecast, including unconstrained demand, unbooking reservations, and expected pickup reservations. We utilize the forecast formula combining history room rate to generate our benchmark room rate, which is $160 for the first month. Comparing to the weekday rate, higher weekend rate was due to the incorrect marketing understanding. Using the rule of thumb, however, overlooked the market segments and demands. Apparently, discounted markets such as the corporate business travelers is less price sensitive than the leisure market. However, this mistake was only recognized until March. In January, due to the aggressive weekend rate, our ADR and RevPAR both were above our comp set. Consequently, we had a big sacrifice in our occupancy. However, we achieved a very high rate efficiency, which is 99%. Starting in April, we start to focus on a competitor's rate, which is, however, not an ideal choice. The rate could not correctly reflect to our level of products, but purely follow the others. There were two main reasons for making this decision. Firstly, competitors had a similar product or facilities. Secondly, we believe a high rate was an important way of keeping our ADR, considering the limited market volume. By doing this, our rate structure appeared impatient and aggressive. In addition, the rate variance between weekdays and weekends was just between $5 to $10, which we noticed was not really helpful. Although we secured 2,800 room nights booking from a group in May, we did not achieve expected result. Considering the occupancy this group contributed, we should have tried to increase our rate aggressively in order to achieve high RevPAR. We apparently missed this opportunity. Due to the peak season, we expected high occupancy with high rate in Q3. Based on this focus, we kept on increasing the rate in July and August. We achieved the highest room revenue in August with a bar rate at $200 at weekdays and $210 on the weekends. But the rate efficiency dropped to 85%, which indicated that there was an increased variance between the bar rate and ADR. Our rate was not performing as healthy as we expected.
So now we'll take a look at the strategy we employed when considering refurbishment facilities and services. As the beginning of the year was expected to be quiet for leisure and premium customers, a decision was made to upgrade the premium rooms with a soft goods redo. This was supplemented by additional cleaning throughout the hotel. This meant 41 rooms were out of commission for the first 2 months of the year, with a further 16 out of commission during the month of March. Although these rooms were back online during peak periods, further consideration should be given to how this rollout of room redos could be performed in order to make sure that we were maximising revenue throughout the year. While substantial cleaning of the hotel was undergone throughout the year, it is clear that there was also demand for additional investment in services and facilities. Due to budgetary restrictions and no access to credit, we were reliant on the initial reserve fund and monthly contribution to support spending. This meant that there was a reluctance to put rooms out of commission for significant periods of time, and so we had to forego the idea of any hard refurbishments and hard goods redos. Although small groups were not identified as a target until later in the year, a decision was made to target them in the second half. Refurbishments of meeting rooms were lined up to be completed in the middle of Q4, and a transport van was also brought online in November. These were designed to support changes that had been made earlier in the year to improve services for leisure customers. For example, the lobby bar and kiosk, tour and travel desk and retail shops. Again, these facilities did not drive the acquisition that we had desired within the core segments, and on reflection, targeting business customers midweek could have provided the hotel with a better opportunity to deliver positive returns on equity and investment. As such, capital investment would have been redirected towards the development of potentially a fitness centre or business centre.
When analysing our performance in marketing and advertising, we did not achieve the revenue mix we had planned from the target segments we initially identified. Instead, we overperformed for transient customers in standard rooms without maximizing potential for growth of the large groups and premium customer segments. This could be attributed to the lack of suitable facilities and uncompetitive rates offered to potential guests when looking at similar properties in our comp set. In addition to this, we should have shifted our focus to smaller groups earlier in the year in order to achieve higher penetration in the second half of the year when their demand increased, following the rollout of new tourism initiatives in the city as well as the busy holiday period in December. Our initial strategy started off allotting our budget into our target groups, which are transient and groups business. Our aim in general was to be number one in regards of spending in our target customer segments in order to quickly gain market share. We pursued this strategy the entire year by means of benchmarking ourselves against the comp set. We focused on the relevant channels which were important for business, in our case direct, GDS and OTA. We also decided to allocate a small amount of our budget in the discounted business in the beginning, as we believed we could capitalize on it as it would potentially be ignored by other hotels. As soon as we realized this was not the case, we decided to drop advertising in that segment in order to prevent further diminished revenue returns. We advertised very aggressively and spent approximately 6% of our revenue throughout the year. However, this was in line with the marketing spend across our comp set and so deemed necessary in order to improve awareness. In May, we pitched for an RFP which we won and gave us high occupancy rates during the weekdays. Therefore, we adjusted our advertising spending to focus on attracting additional customers on the weekends. In June, our competition focused on spending heavily in advertising on weekday business, which had a heavy impact on our occupancy. The main reason for this is that we had dropped our weekday advertising significantly, and therefore it was impossible to benchmark us against our competition. We adjusted our advertising budget to equal approximately the expenditure of the prior month, April, in which we were leading.
Our channel management strategy was originally constructed to optimize costs, focusing primarily on direct business. With a very close relationship to a marketing investment, our strategy was designed to maximize revenue and build a direct relationship with our customer. Over the course of the year, however, our proportion of direct business stayed relatively flat, apart from the May when directly acquired a significant RFP for that month. After the first quarter, we realized that costs associated with our channel management strategy did not have a significant impact in our profit. We experimented an increasing OTA and GDS during the year, from quarter to quarter, but little improvement in overall sales. During the months of September and October, we allocated more effort to direct business during the weekends, and more OTA and GDS during the weekdays. During the year, we also dedicated over 65% of our effort to our direct channel, while the rest was distributed evenly between OTA, GDS, and wholesale. On average, our direct channel approach accounted for 65% of the transient market, 80% for the discount segment, and 100% for our group business during most of the year. When deciding on our rate reduction and increased strategy, we opted to be relatively stable during the year.
So having reviewed the year in full and each quarter individually, we arrived at the following conclusions. Our revenue did track the expected pattern in line with seasonality. However, the drop-off in Q4 was unexpected for the most part and resulted in poorer than expected year-end performance. Following a steady increase across Q1 to Q3, GOP peaked in August at 44%. Despite falling off in Q4, the objective of achieving a GOP of 25% or over was achieved, with a figure of 33.69 at year-end. ROE was lower than the objective of 6%, representing a poor return for investors. This was driven by the fact that, following a poor start in Q1, where negative returns were reported, the hotel failed to recover these losses over the remainder of the year. Significant attention should be paid to Q4. Despite investments into facilities and services, the hotel still failed to acquire sufficient market share to drive revenue and net income growth. Having analysed the strategies deployed within each department, the following additional conclusions were also arrived at. Inconsistent pricing strategy led to inconsistent penetration across the market. An inconsistent targeting strategy led to an inability to achieve sufficient market penetration across segments and channels. During periods of high demand, more aggressive pricing strategies could have been pursued in order to maximise revenue. And finally, service, facility and refurbishment improvements need to be better organised in order to come online at the right time for target groups.
To wrap up our analysis, we would like to present you with the following recommendations. To use a price as a key differentiator within the target segments and allow for greater flexibility on rate when occupancy is low. In example, as long as total cost is covered, a room should be sold at a marginal rate. Second, rationalize spending on services, facilities and refurbishments. Focus on full-scale renovation of all rooms to be phased across the year in order to minimize the impact of rooms out of service. Third, invest in a large-scale facility that will have the ability to differentiate further from competitors and align this with the target segments. In example, business center if targeting business travels, spa if targeting premium leisure travels, fitness center in order to appeal to a broad range. Last but not least, disengage from a wholesale selling and increase marketing and advertising spend through direct, GDS and OTA channels. Thank you very much. I hope you enjoyed the presentation.